Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas. Today on the show, we have Tom Wheelwright. Tom is a CPA and CEO of Wealthability. He is the best-selling author of Tax-Free Wealth. He's the founder of Tax-Free Wealth Network and the host of the Wealthability Show. He serves as a Rich Dad advisor alongside Robert Kiyosaki, who is known for his book, Rich Dad, Poor Dad, and he is best known as in helping us make more money and pay way less taxes. So it is my pleasure to introduce Tom Wheelwright. Welcome to the show.
Hey, thanks, Juan. It is great to be here on the show. I always love talking with people who are interested in, building their wealth and getting educated about how you build wealth and reduce taxes. It's awesome.
Yes, that's one of the things that most of us did not learn, in school. We didn't learn necessarily about taxes. We learned to go get a job, to go to college and, make a good income, at a new career and, pretty much do that the rest of our lives. But one thing that we didn't learn so much, which is more likely the biggest expense that everybody has throughout the year, is the taxes. Your taxes, if you really think about it, your taxes is what costs you the most. And I actually have asked people out there, just to kind of throw it out there, I've asked people, hey, what is your biggest expense throughout the year? And so one of the first things they say is my mortgage, or they will say, just a car payment or something to that matter. I'm like, have you ever thought about your taxes? And once they think about it, they're like, you know what, you're right. It is taxes. And so again, it's my pleasure to have you here on the show. And that is what we're going to discuss. Specifically, we can talk about some of the new changes with the new laws that took effect with Trump. And we can go into many details and how it can affect many of the folks out there. So first of all, thank you for being on the show. And, let's get started with, tell us a little bit about your background, and, we'll kind of fast forward to, the tax laws.
Yeah, sure. Of course. Thanks, Juan. So I grew up in Salt Lake City, Utah,
Okay.
Heart of Mormonism. So when I was a young man, 19 years old, I was expected to take off on a 2-year mission for the church, voluntary mission. And I spent 2 years trying to teach Mormonism to Catholics in Paris, France. So in French, which I learned all about rejection firsthand, which is actually a great start to being an entrepreneur. As you know, it's if you can't handle rejection, don't try being an entrepreneur.
Yeah.
So I did that, and I love the French. I love Paris is my favorite place on earth. And from there, I went to the University of Utah, where I had got my Bachelor of Arts in Accounting. I went on to the University of Texas in Austin, where I have my Master's of Professional Accounting with a specialty in tax. I spent 7 years with Ernst Young, 3 years in their National Tax Office, Washington, D.C. Actually, the last time we had major tax legislation, 1985, 86. And I was there for that, which was a very different experience than this last major tax bill. And then spent 4 years as in-house tax advisor for a Fortune 1000 company. And for the last almost 30 years now, running my own CPA firm and actually building multiple CPA firms. So very excited. Now we're actually out there helping other CPAs, not just building their own CPA firm, but helping other CPAs really serve their clients better, particularly their entrepreneurial, their real estate investor clients, how to reduce their taxes and make more money.
There you go. That's the whole point. Yeah, that's the whole idea. Okay, so you told us a little bit about your background, and from my understanding, the biggest or the last biggest tax reform or change was, as you mentioned, was 1986. So how has it evolved, over the years, and in your opinion? And what was the biggest changes here lately now with the newest one with Trump?
Well, so interestingly enough, the biggest losers in the 1986 law were real estate investors.
Okay.
And the biggest winners in the 2017 tax reform were real estate investors. So completely flipped on its head. 1986 was a bit of a simplification because we went down to 2 rates for a very short time. We had only two rates, 15, 28. And they were trying to simplify they killed the real estate industry in the meantime. The savings, they actually eliminated an entire industry as a result of that law, the savings and loan industry. So we don't know what all the collateral tax effects are going to, all the collateral consequences are going to be of this tax law. What we do know looking backward is that the big collateral tax consequences of the 86 Act was basically the decimation of the real estate business, which interestingly enough, if you've read Rich Dad Poor Dad, that's where Robert and Kim first became financially free, was as a result of the 1990 real estate crisis that was brought on by the 1986 tax law. So ironically, Robert and I travel the world talking about how to reduce your taxes and pay less taxes by buying real estate. And he gained his financial freedom as a result of the last big tax law. So pretty funny stuff.
No, it is. It is. And, it's unfortunate that it happens that way, but, that's how a lot of people are able to build their wealth, is through, these kind of, down moments, down cycles that, people take it, they can jump on it, those opportunities.
You make way more money in a crash than you do in a boom.
You're right. Yeah.
Because it's all about, when you're talking about investing in assets, you're talking about, it's all about when you buy it, much more than when you sell it. Because especially if you're investing for cash flow, like you're a real estate investor, and real estate investors, particularly in the multifamily business, are really primarily interested in cash flow. And if your focus is on cash flow, then boy, the less you pay for it, the better off you're going to be.
There you go. There you go. And yeah, you pretty much said it right there. So let's go ahead and get into some of the biggest changes in his or in the newest, tax reform. And so you mentioned that it favors real estate investors the most. So I'm assuming that it doesn't favor, I guess, 9-to-5ers,
well,
guys.
Actually, employees got hammered. So, you heard a lot. I mean, the things you've heard about is the reduction in the deduction for the mortgage interest, right? If you own a home, there's no reduction in mortgage interest if you buy a home for somebody else. So if you're a real estate investor and you're providing housing for somebody else, you still get the full deduction. So there's no limit. So you could literally buy a $5 million house, and if you rented it out, you get the deduction on the full mortgage interest, even though on your own home, you're limited to $750,000 mortgage, right? So, and then, we know state taxes and property taxes are limited as well for individuals. Again, property taxes are not limited for a real estate investor. They're only limited for a homeowner. There were other tax benefits that went away, and interestingly enough, a lot of the individual tax benefits, that what you call the 9-to-5ers, their benefits, they were eliminated permanently. So while a lot of the tax benefits, the real estate tax benefits are temporary, the small business tax benefits are temporary, the elimination of the tax benefits for the individuals are permanent, as is the reduction in the corporate tax rate. So those were the two, really the two big changes that were made permanent. Everything else is, here for 5-6 years, then it's gone.
Okay. So we'll kind of touch on that a little bit. You mentioned in 5-6 years, we'll kind of go back to that, but, I want to kind of go back to the point that you mentioned about the mortgage interest. So for those of us that have a home already, like we bought it last year or 2 years ago, does it sort of grandfather in? Are we still able to?
Does. You're good to go. That's the same rules. $1 million. We always had a limit, right?
Okay.
Had a limit for a long time, $1 million, and so that's grandfathered in. So it's only new homes that have that $750,000 limit.
Gotcha. Okay, so going back to what you mentioned this is only here for a few years. So it's an opportunity for those of us that want to take advantage of, it's a wonderful opportunity, basically what we're seeing here, right? So when exactly does it go away?
So it goes, it phases out, depends on which part of the bill you're talking about, but pretty much by 2026, it's gone. Okay, so, you really ought to be looking at the next 5, 6, 7 years to take advantage of this bill. And there's a reason for that. The way they run the budget is they have a 10-year window basically. And if they're not within that 10-year window, then they have to they have to include a lot more money. So that's why they phase that out at the end of the 10-year, basically that 10-year period. 2017 to 2027 is effectively that 10-year window. Now, what's interesting is just how big the tax benefits are for real estate investors. You know, for the first time in history, in U.S. history, the tax benefits from buying real estate the very first year are greater than the tax benefits from investing in oil and gas. I don't know if you knew that, but, you know, oil and gas, we think about oil and gas and you go, wow, if I invest, I've been on the stage with Robert, of course, all over the world, and we'll get on stage and he'll say, well, so if I put $100,000 in, you know, what's my tax deduction? And I, you know, up until this year, I would say it's $80,000. You got 80% deduction the first year. Now you actually get $100,000 for oil and gas. But if you took that same $100,000 and invested it in real estate, as long as you're leveraging. So let's say you take $100,000, you borrow $400,000 from the bank and buy a $500,000 property. Your first year deduction is likely to be about $150,000. So you've invested 100 and you got $150,000 deduction.
Wow. So
from that bonus depreciation, it is absolutely amazing. Do you know, I mean, it's so big, Juan, that if you have money in your IRA and you decide I'm going to invest in real estate, you can pull the money out, pay the, and have tax and penalty assessed against it. And as long as you reinvest in the same year that you pull the money out and you leverage on a 4-to-1 basis, you know, 80% loan to value, you will actually be net positive on your tax benefits, even after paying the tax and the penalties on your IRA.
That's incredible. So, I mean, it's just so powerful, the new law. So, I mean, it's just mind-boggling that you can get even, you know, just as good as the oil and gas, or even better, you know, the first year, basically, you know. And, you know, I'd really like to discuss that more in detail. You know, it's called bonus depreciation. Is basically what you're talking about, right?
It is. It's called bonus depreciation, and it's optional. You don't have to take it. So if you don't have, you know, big income one year, you don't have to take bonus depreciation. Here's basically what's going on with bonus depreciation. Normal depreciation. You buy a property. Let's say you buy a 200-unit apartment complex, and you go buy an apartment complex. You're really buying 4 types of property. You're buying the land, right? And everybody knows that's not going to wear out, so that you get no depreciation deduction for that. You buy the building, and that's what most people base their depreciation on, and that's like 3.5% a year, so not too bad.
Right.
But then you also buy the land improvements, like the landscaping and the outdoor lighting and the covered parking, all that kind of stuff. And you buy all the contents of the building, which includes window coverings and cabinets and washing machines and, you know, everything that's inside, basically everything that's inside outside of the shell. Well, typically, and I just got through looking at one of my personal clients just bought this nice property, and he did a cost segregation, which means that you have a professional come out and determine what portion of the property, you know, is building, what portion's land, what portion's contents, what portion is land improvements. And it came up to about 30% of the cost of the property was attributable to the combination of land improvements and contents. Well, bonus depreciation is 100% deduction first year for land improvements and contents, even if it's a used property. So the big change in the law this year, we've had bonus depreciation for a long time. The big change in the law, though, is that bonus depreciation used to only apply to new property. So it didn't apply to used property. Well, so here's an interesting comment on U.S. tax policy. We're one of the few countries in the world that allow any depreciation on used property. Most countries, you have to build it new or you have to buy it new in order to get the depreciation. Now, not only do we get depreciation on the used property, so for example, you could buy a property, take bonus depreciation, turn around, sell it in a 1031 exchange, not pay tax, sell it to me, I can then take bonus depreciation. I can then turn it around the next year, sell it to Sally Smith down the street. She can take bonus depreciation. You could literally take bonus depreciation every single year and nobody ever pays tax because we're all doing like-kind exchanges. So it's the cost to the Treasury, if people take advantage of this, like I think they will, the cost
Yeah.
to the Treasury is going to be absolutely enormous.
Yeah, I mean, it definitely will. I hear all the time where guys are buying buildings, left and right because of the tax, tax deductions that they can get in tax incentives.
Well,
So,
I'll give you an example. So I was doing an example. I'm creating some new educational products, and I was doing an example, and on a $100,000 single family home.
okay.
Your tax benefit in a 25% tax bracket. Now, most people are in a higher tax bracket than that. In a 25% tax bracket, your tax benefit is as big as your actual cash flow, even if you got a 10% return on that property.
Wow.
Unbelievable.
Yeah, that's huge. That's huge. So Tom, obviously, it's more of you're deferring your taxes, right? So to speak. So you have to recapture those taxes, at a future point in, sometime in the future. So, how does that part work? So let's say you do have this, you buy a property, you're doing bonus, depreciation. You have the property for say 5 years. At the end of 5 years, you look at your options. You're like, okay, well, a 1031 is not gonna work for me at this moment for whatever reason. You decide to sell. So then what happens?
So so first of all, I have to ask a question. Why not do a 1031? Because what a 1031 does, remember, you can do any investment real estate for any other investment real estate. You could take your multifamily and go buy Walgreens. You could take, go buy a triple net lease. You could take your multifamily and go buy a piece of land. There's all sorts of things you could do. Now, here's the other thing. People say, yeah, but I want to take my cash out. Okay, well, borrow it out. We have a philosophy we call buy, borrow, die, right? So you buy the property. As the equity increases, you borrow it out and you actually use, that's the cash that you use to buy other properties instead of selling the property. You borrow it out. And then eventually, if you keep doing 1031s, when you die, your taxable, that recapture goes away. It disappears. It's called a basis step up, and that recapture completely disappears. And we have a $20 million exclusion for estate tax between husband and wife. It's over 20 million. So most people can buy, borrow, and keep doing this. And then when they die, their income tax goes away and they don't even have any estate tax. So I don't know why people think
wouldn't.
It's not that hard to do a 1031. It's way less expensive than the tax. And not only that, people get a little scared because let's take a market like this, right? We're in a bit of kind of a hot market when it comes to multifamily, right? And so people are going, all right, we're in this hot market for multifamily. I don't want to be forced into buying a property I don't want. So here's what you do. You buy the property that you do want before you sell the property that you want to sell. This is called a reverse 1031 exchange. You have to use a qualified intermediary. It's a little more complicated than a straight 1031 exchange, but you can buy your property. I've had clients that bought it 3 or 4 years ahead of selling their old properties. They just all tie it up with a qualified intermediary. You set it up properly, and it's just not that difficult, and it will save you, literally can save you millions of dollars in taxes.
I didn't know you can go back or you can buy it like 3 or 4 years even ahead of time. So there's no time limit on that?
Well, the IRS says 2 years, but the law doesn't say 2 years. So I've actually, the law, the IRS says, well, if you buy it not more than 2 years, they will absolutely bless it. If you buy it more than 2 years, you still have an argument because all the law says is that you have to close within 180 days after, but it says nothing about before. So you could absolutely do it ahead of time. And at least you ought to be looking for that new property. If you're contemplating selling one of your properties, then you ought to be looking for that new property immediately and make sure that, okay, let's find that new property, and then we don't have to worry about the 45-day identification rule. We don't have to worry about the 180-day close because we've got plenty of time.
Gotcha. So in that same scenario, what if somebody did, for whatever reason, they decided to sell instead, and and they had taken advantage of the bonus depreciation, so they have to recapture those taxes. So how would that
Well,
affect them?
some. Okay. Now you
Hmm.
don't have to recapture all your taxes
Hmm.
because remember that when you sell real estate, first of all, you're after 5 years, your contents aren't going to be worth anything. I mean, they're just not going to have much value.
Right.
So you're not really going to have any recapture on the contents. You may have a little recapture. You're probably going to have some recapture on that, um, on those land improvements, but the building depreciation recapture is at 25%. So let's say that you're in a 40% tax bracket.
Hmm.
So you get a deduction now at 40%, but when it's recaptured, it's at 20 to 25%. So you're still better off even on the net. But the other thing is that you've had 5 years use of that money. So think about the properties. Every year you had that money, you keep buying new properties. Well, let's say 5 years from now you sell it and you have recapture. So what? Buy another property. Even if you're not going to do a 1031, there are actually times now, you'll love this one, there are actually times when doing a 1031 is less beneficial than paying the tax and buying a new property.
Okay, this is interesting.
Because the bonus depreciation is so
Yeah.
good. So you
Hmm.
might get, if you can get bonus depreciation that offsets 40% income and you're paying tax at 25% on the gain, you're better off not doing a 1031 exchange.
Yeah. So for you to know that, you have to have somebody on your team, such as yourself, to kind
Yes,
of
you
plan
do.
for that. Exactly. Right.
You have to run the numbers. I mean, your tax advisor is going to be the most important person in your life financially outside of your spouse. And so make sure that you got a tax advisor who always runs the numbers, that you're always talking to them. Here's what I'm going to do. Here's what I want to do. Because you never know what, as you start talking about it. I find that when I talk to a client about their transaction, something will come up and some opportunity will come up that frankly neither of us had ever thought of before, and it comes up because we're having the discussion.
Gotcha. Okay. Well, then that was a lot of good information right there. So hopefully you guys were able to pick up a couple of things, from what Tom just shared with us. I guess we can go ahead and talk about the uh, charitable donations. Tell us how that, if anything, changed on that, and we'll kind of go into a couple other ones like using your home office, your child, but we'll talk about charitable donations, first. So.
So what changed with charitable donations
Mhm.
is, we used to be limited to 50% of our income could
Okay.
be donated and get a tax deduction. Now it's up to 60%. So that is a nice increase. And let's say that you've got some appreciated property. Let's say you got some property that's gone up in value. You can donate the property, you get a deduction equal to the value of the property, and you don't have to recognize the gain. So that's another, you talk about the recapture, that would be a way to avoid the recapture, get the tax benefit,
Definitely.
and then get the tax benefit of the charitable contribution. And you can give away a partial interest in real estate. I mean, it's pretty easy to set up a limited partnership. You can be the general partner. You can even control the asset, even though you've given a limited partnership interest to the charity.
Hmm. That's interesting. Okay. All right.
Yeah,
Well,
there's
then,
all sorts of cool things you can
yeah,
do.
there is, once you think about it, we don't, we haven't even discussed, a small percentage of what's out there really with the tax laws. But that's why you got to have a good guy like Tom on your team to kind of, show you what the best way and what the best strategies are for everybody. It's a different situation, right? So you have to know more about them and their situation to be able to help them out the best. So what about your automobile? Tell us a little bit about that. I know in the
So,
past.
so in the past, we've had very limited deductions for cars, right? I mean, we all know that. I mean, it's in like, $3,000. I mean, it's like nothing for your car.
Okay.
So here's what happened this year. So the bonus depreciation applies to cars. Now it's limited to on passenger cars. So it's limited to $10,000 on a passenger car. Still, instead of getting $3,000, the very first year, you're going to get about $18,000 if you use the car for business, right? If you don't use the car for business, you're not going to get the deduction anyway. It's a business deduction. However, If you have a truck or an SUV that weighs more than 6,000 pounds, that deduction is not limited. So let me give you an example. You go out and you buy an $80,000 SUV, full-size SUV, and you use it 100% for business, and you put nothing down. The bank or finance company finances the whole thing. You get an $80,000 deduction the first year. So what you've done is you've put nothing down, and at a 40% tax rate, you put $32,000 in your pocket. So you've actually made money by buying the car that first year. Now you got to pay it back, obviously.
Yeah, right.
But the goal is that your business pays it back, right? Your business has income and you're actually using it for business. The car actually makes you money. There's a reason that you have it for business. The challenge that most people have is they don't use their car that much for business, because remember that the very first trip you take every day is a commute. And the very last trip you take every day is a commute. And commutes are not business. So what'll happen is, take a real estate investor like yourself, Juan. You go out to see a property.
Okay.
First thing in the morning. That's a commute. That's not deductible. At the end of the day, you leave a property, you come back home. That's not deductible. So you might end up with only 50% of your day being business, even though you spent the whole time seeing your properties. Well, here's where a home office comes into play. If you start your morning at your home office, it's used exclusively for your real estate business, and you end your day at your home office, then your commute is the 30 feet from your home office to your kitchen. So you've eliminated the commute from an IRS standpoint for your car, and in many cases it'll double the amount of deduction you get for your car.
That is interesting. Yeah, that's very interesting to know that. I didn't know that your first drive, your commute, like you mentioned, was not deductible. Or even your last. Do you know why that is? What's their explanation for that?
Their explanation is that's commuting, and it doesn't matter if your job is your real estate investment or not. That first drive is a commute. That's the rule. It's always been the rule as long as I've been in this business. It hasn't changed. What they're very clear on, though, is that if you have a home office, there's a revenue ruling on this. It says if you have a home office and you go to your home office in the morning and you do your administrative work, and then you go to the home office at the end of the day, then if you do that, then that commute, that first and last trip of the day become tax deductible.
Gotcha. Okay, so now that you mentioned the home office, what are the requirements for you to qualify as a home office? I mean, does it have to be a certain size? I mean, how long do you have to use it? Or
so you're sitting there in your home office right now. I can see you in your home office, right?
Pretty much,
now,
yeah.
Okay, now because I can see the Rich Dad Advisor books on the book.
Yeah,
clearly, this is
I have your book as well.
Right, so I can see that from I went to the purple and the purple colors right away.
I went right there. Yeah.
Right there, exactly. And so the requirement is, it doesn't matter what size it is. The requirement is that it's used exclusively. Now, let's say you have a living room and you put your desk back in the corner and you use the front of the living room, you put your television, your sofa, and that's family area. But the back of the living room is exclusively your home office. As long as the area is exclusive for your home office, it doesn't matter how big it is. It doesn't matter, which room it is. It doesn't matter. It must be exclusive. So on the other hand, let's say that you have that you have an office that you've turned a bedroom. It looks like you've turned a bedroom into your home office there, which is common, and you've done that. But in addition, your kid's PlayStation is in there, and you got a little play area in there. Guess what? That's not exclusive, so you don't qualify. So just make it exclusive. Now, the other thing about a home office is the deduction is a percentage, right? It's a percentage of your office compared to your entire home. All right, now we have to consider how do you calculate that percentage? So what most people do, and this is one of the ways the IRS says is allowed, is they take square footage.
Okay.
Well, okay, that's fine. But let's say that your square footage, you've got a lot of common area, right? So that means you really lose a lot, even though you use that common area for business, you do. It's a percentage of, of the home that you're using because you share it with the home. So what the IRS also says is, as an alternative to square footage, you can use number of rooms as long as
Mm.
they're approximately the same size.
Okay.
So, you've got a bedroom there. Let's say you've got a total of 10 rooms in your house, counting your living room, your dining room, your kitchen, right? You're not going to count your bathrooms. You're not going to count your hallways because those aren't rooms, right?
Hmm.
Okay, so now instead of having a 3% home office deduction, you may have a 10% home office deduction. So those are both allowed. They're in the IRS instructions. They're very clear that they're both allowed. So just take the bigger.
Okay, nice. Yeah, well, thank you so much for explaining that. For those of you guys out there that do business, I mean, you might want to think about doing that as well. It's very beneficial. I mean, if you can get it, then get it, right? So, um, here's one of the things that I would like to discuss as well, and mainly because I have some children, and this is how you can basically pay your children and use that as a way to save on your taxes, as a deduction, so to
This
speak.
is
So
a big change in this new tax law. So we now have a $12,000 standard deduction for
okay,
every individual taxpayer, and that includes children. So that means that the first $12,000 that your children earn is tax-free. So if you're let's say you're in a 30% bracket and you pay your child $12,000, that's worth $3,600 to you, right?
hmm,
But the child doesn't pay taxes on it. Now, if you wonder, is this really legit, right? People always wonder, is this legit? Well, let me tell you how legit this is. So remember that all incentives in the tax law, except for loopholes, and we're not talking about any loopholes here, all incentives of the tax law are intentional incentives because the government wants you to behave a certain way. So everybody I've ever talked to said, when I talk about their children working in your business, think, well, that's a great idea. My children learn how to work, and I keep them off the street, and they don't cause trouble, and there's all sorts of positive social benefits for that. Well, on top of that, do you know that if the business is owned by you or you and your spouse, there's no Social Security taxes either.
so that's an
So they
added
don't have to pay
benefit.
Social Security taxes or self-employment taxes, so they literally can pay zero tax even though you're getting a tax deduction.
So Tom, how do we actually go about doing it though? So, um, let's say that we do want to proceed with this, right? So you basically set up a couple of different accounts for them, and you roll in some money into those accounts. What specific type of paperwork do we have to account for, or maybe our CPA, like somebody like yourself, has to account for, and how will the government even know, or the IRS even know that we even paid them? How do they keep track of that?
Well, so you have a choice. Either they're an employee because they work for you on a regular and continuous basis.
Okay.
And if they're an employee, you're going to actually give them a W-2. Okay,
Okay.
you're going to give them a W-2. You're not going to withhold anything, and you're not even going to withhold Social Security taxes or Medicare taxes. Okay, if you qualify for that, right?
Right. Hmm.
So they'll get a W-2.
Okay.
Okay, now you won't have to, if they're under $12,000, they're $12,000 less, you don't even have to file a tax return for them. So the IRS knows, and that's your documentation, but there's really nothing else to do except file the W-2. The other way you can do it is, it may be that they do it on an ad hoc basis. It's not a regular basis, like, they do Saturday, they do projects, right? And then you pay them for the project. Well, in that case, you're going to send them a 1099, right? A 1099 is what you report to the IRS, and that reports that they received self-employment income. So just FYI, if they get wages or 1099, they could also put money into a Roth 401k, or they could put money into your real estate business. I mean, you have a lot of uses for those funds. You can't use the funds, be careful, you can't use the funds for what you're legally obligated to pay for. So you can't use them for housing, you can't use them for clothing, you can't use them for food. But you can use them for family vacations. You could use the money for family vacations. You could use the money for their after-school programs, their sports, their music lessons. You put the money aside for college. You could have work with them to invest in real estate. I mean, there's a all host of number of things you can do, and you get to control it, because guess what? If they're a minor, then they don't get to control that money anyway. On top of that, if you get them, you can either get them to put it into a trust, where you would be the trustee, or they put it into a limited partnership or a limited liability company where you're the manager, then they don't get to control it that way either. So, I always think with kids, not bad for them to have a little bit of spending money, but the rest of it, I want to control.
Mm-hmm.
And there's plenty of ways to do that.
Okay. Yeah. I just wanted to kind of clarify that. And you pretty much did, that's, there's a lot of different ways that you can actually use those funds. So that's good to know. Tom, I think we want to, switch gears here and talk about opportunity zones. I know that you can call them enterprise zones, opportunity zones.
They're called opportunity zones.
Okay. So
actually different than enterprise zones.
Okay.
Enterprise zones, is typically a zone that is set up by a state and local government.
Okay.
And they have different tax consequences. An opportunity zone is brand new under this tax law.
Okay.
And basically, you got two major tax benefits with an opportunity zone. The first is, let's say, take your situation that you were talking about where you want to sell that property and you've got recapture, and for whatever reason, you can't do a 1031 right away. You only have to roll the gain into an opportunity zone project and not pay the tax. You don't even have to roll the entire amount. You only have to roll the gain to eliminate, to avoid the tax, defer the tax. So
Okay.
that's one benefit. And you don't have to do a 1031. So you don't need a qualified intermediary. You just track it and you just show that you use that gain. I'm sure there's going to be a form this year for it, that you use that gain and you took that amount of money and you put it into an opportunity zone project. And there are, by the way, the opportunity zone project, opportunity zones all over the place.
Yes.
We have there are opportunity zones in Scottsdale, Arizona, which I'm just going, what?
Yeah, you're like, what?
Opportunity zone in Scottsdale, Arizona. But there are opportunity zones in Scottsdale, Arizona. There's all sorts of opportunity zones. I'm looking for projects right now in opportunity zones. Because the other benefit is that if you hold the project for 10 years, there's no tax liability. You have no gain. So you get rid of your gain entirely. Now, again, now in opportunity zones, we're not talking about buying not talking about buying a used property, doing nothing to it, and think we're going to get this benefit. It's the improvement we do to it, right? So the goal of this incentive is to get people to build new projects, right? Tear down the old stuff, put up new stuff, or improve an already existing building. And it's the improvement cost or the construction cost that's going to get that tax benefit. It's not the existing building that's going to get that tax benefit.
So how much do you have an idea of how much we have to spend? I mean, is it something close to what the cost of the building is? So, for example, you buy the property for $1 million, and do you have to spend a certain amount?
No, it's just whatever amount you do spend is the opportunity zone amount. Okay.
Okay.
So that's the proportion of the building.
Okay.
That you get the tax benefit on. So what we're going to see is, a lot of these opportunity zones are what we would think of from a real estate standpoint as redevelopment zones, right? Places that are on the edge. They're just not a place where you would normally put your money because it may not be the best part of town.
Mm-hmm.
The goal is to let's rejuvenate these areas of town. That's why I'm so surprised that Scottsdale, Arizona has an opportunity zone at all. Right?
Yeah.
Phoenix, I get it. Phoenix, actually, most of Phoenix should be an opportunity zone in my mind. But there's a lot of tough areas in Phoenix that you don't go in those places after 5 o'clock at night unless you want to take your life in your hands. So that's Phoenix, really. Phoenix, Philadelphia. I mean, it's anything starts with a P, I guess, has that.
It's rough, right?
But we seriously, I think it's a terrific. I think it's a terrific tax benefit. I actually think this is a really terrific incentive because I think that as long as the government is careful and doesn't give too many Scottsdales to their opportunity zones, but they really do need to promote this redevelopment. I think it's an opportunity, a true opportunity for those areas that are struggling to get some capital and to get some projects. I know, for example, one of the places I've seen, you know, I mean, seriously, in a city that the whole thing should be an opportunity zone is Oakland, California, right? My son lives in Oakland, and he's always warning me, when you come down, just be careful where you go, right? Oakland's a beautiful city. It's just got a lot of places that are a lot of rough neighborhoods. So, you know, I've already seen some opportunity zone projects in Oakland, which is fantastic. You know, we're going to see opportunity zones in, you know, the tough parts of Philly and Detroit and Phoenix and LA. And, you know, these are places that really do need some redevelopment. And I just think it's you know, and every city has them. Every city, we all have these places. Even places like Tampa, Florida. I've been down Tampa, Florida, and seen places like going, man, that's just so weird. You got this nice part of town, then right next to it, you got this horrible, just worn down, worn out part of town. I'm going, what a great, I mean, to have an opportunity zone there would be great, as if it encourages, because on top of the tax benefits from the gain, you still get the bonus depreciation, you still got everything else. So it's not like you lose any of the other tax benefits. This is just an additional tax benefit.
Yeah, and you know, there's a map out there. I'll actually put it in the show notes for you guys to check out. There's a map where you can just click on it, and then you know, it'll literally have like the whole U.S. and you know, there's different pockets throughout each state and throughout each town, each city, and you can go in there and see where you know, where the opportunity zones exist. So you mentioned that you know, this is for 10 years. So what happens if we don't hold the property for 10 years and we hold it for say 8 years? Is there a percentage that or how does that work exactly?
You know, I have to go back and read those regulations. I don't know. I don't know the answer to that.
Okay.
I believe it's a percentage, but I honestly, I can't tell you off the top of my head. Those regulations are fairly new, right. And I've not poured through them quite all the way yet.
Okay, no worries. And you know, one last question, I guess, on the opportunity zones. From my understanding, you have to purchase the property. What was it at the end of 2017? From then on, or because if you have purchased the property like beforehand, then you wouldn't qualify for it, right?
Right. And that's same with bonus depreciation. That's same with all of these tax benefits.
All of them, right? Okay.
You know, the opportunity zone, I believe that effective date is January 1 of 2018.
Okay.
The bonus depreciation, the effective date is September 27th of 2017. So we had bonus depreciation taken on, a lot of our clients were taking bonus depreciation in 2017. But there's always an effective date. And that means that, let's say you own a property that you own for 2 or 3 years, you do a cost segregation, you're not going to get bonus depreciation on that. It's only properties purchased after the effective date.
Gotcha.
Thanks for clarifying that.
Okay, gotcha. And do you know also if there is a date by, you know, such as like the new tax laws that we only have up until like 2026 or so? Is it the same for the opportunity zones? Are they going to go away as well?
It is. They're temporary. They're temporary like everything else. So this is, you know, it's a good way to put it. It's an opportunity zone right now. So
exactly.
The next 5, 6, 7 years is a real opportunity zone for real estate in particular.
Gotcha. Okay. Well, good. So yeah, I mean, we have pretty much covered a bunch of different subjects, you know, on taxes. What is your opinion, Tom, on what's going to happen, you know, here moving forward? You know, obviously what we have set in place right now, you know, is going to be in place for the next few years. But what do you see? And it's kind of hard to say. So it's kind of like a vague question. I understand that. It's kind of a broad question. But how do you see the taxes changing over time, moving forward, maybe in the next 10 years or so?
Taxes don't when taxes go down, it tends to be a big deal. We're not going to see taxes go down. I mean, we're not going to have major tax reduction again, I don't think, for quite some time. And in fact, I would foresee, you know, it depends on what, you know, who's running the government
Right.
2 years from now, right? Because we're pretty sure that unless the Republicans pull off a miracle and they actually win the House and the Senate again, we're not going to see probably additional tax changes or tax benefits in the next 2 years. So I think we're probably stable for the next 2 years.
Mm-hmm.
After that, it's going to depend a lot on who wins Congress and who wins the White House. I do believe that if you see the Democrats win the White House, you're going to see some tax changes.
Mm-hmm.
If they also have control of the House and the Senate, they're going to do their best to unravel some of the corporate tax benefits, and they're going to do and certainly these real estate tax benefits. Man, I'd be jumping all over them because I don't see them lasting a long time.
Gotcha. Okay. Well, then that's something good to, even if they do last, you know, they're still good incentives. So, you know, jump on them either way. But especially if they do go away, you know, then, you know, we just don't know what the future's going to hold. So Tom, I guess, you know, I can ask you a couple of different questions. I mean, what is a good tool, source, or platform that you use like almost every day that can also help others that are, you know, that want to maybe reduce their taxes? I mean, besides, you know, getting in contact with somebody like you, but what kind of tool they use that maybe others can use as well?
You know what? I'm a big believer in teamwork.
Mm-hmm.
And I think you should have a really good tax advisor. And that's actually why we formed the Tax Free Wealth Network, is so that we're building a network all over the world. We have, literally, we have people that are waiting to join our network in South Africa, in Australia, in Hong Kong, in Singapore, in Mexico, just because what we're seeing is, the CPA profession is a bit stagnant right now, and it needs a major transformation. And so, you know, I just looked at him going, look, I've got the experience. I've got a bit of a brand here. So if anybody can change it, why not? You know, why not us? So
Right.
we're out to transform a profession worldwide, and we're hitting a chord. There's a lot of people, and I would actually throw out a plea there that if you have a tax advisor that you go, I love my tax advisor, they just don't understand this stuff, send them over to us. Just send them over to wealthability.com, and we would love to be talking to more tax advisors. Spread this word more. You know, if you can't find a tax advisor, you can also contact us, and we'll get you into one of our network tax advisors. But I think your number one resource should be your tax advisor.
Got it. No, and I agree. You know, it should be, you know, someone along your side that's going to be able to help you out. You know, especially if you're in real estate like we are. You know, that's what our podcast usually focuses on is real estate and multifamily. I mean, having a CPA, I mean, couldn't have said it even more. I mean, it's very, very important to have somebody like yourself on your team. You know, I did want to ask you. You kind of discussed it a little bit, but I wanted to ask you. You know, what kind of separates you and your firm versus, you know, the ton of CPAs out there? And I know, like I said, you know, you discussed a little bit about it, but, you know, why are you, you know, seen as, you know, a couple notches above than everybody else or a lot of people out there?
I think there are a couple of things. First of all, you know, education matters. Education does matter. And how you see, you know, really how you see things has a major impact on what you do. So we look at the tax law as a series of incentives. That's all it is. It's a series of incentives intended to benefit, encourage you to do what the government wants you to do. So we're looking at this as, we see taxes as a positive, not as a negative. We're not afraid of the IRS. Nobody in our group's ever going to be afraid of the IRS, which, by the way, if you've ever been told not to take a deduction, that's because your tax advisor is afraid of the IRS. So seriously, I mean,
yeah.
Why would you not take a tax deduction you're entitled to? And that's typically home office, by the way. Oh, it's scary. They might audit you. Going, first of all, if you do it right, you're not even going to know you have a home office. And second of all, so what? I mean, if you're so afraid of an audit, then should you really be preparing tax returns if you're afraid of the IRS?
Mm-hmm.
So I think it's really a matter of attitude. and understanding of the tax law. The more you understand, the less risky it is to do tax planning. You know, we just study and study and study the tax law. I know I still got a little studying to do on the opportunity zones. Okay,
It's okay.
I know that. I'm going to do that. That's on my list between now and the end of the year. And it's a huge major tax law change, right? We've got a new 20% deduction. We've got the bonus depreciation. All of these have regulations, and we're doing everything we can to keep up with them. But that's the other thing, is you want to make sure that you've got a tax advisor that is reading the regulations. I mean, when the new tax law came out, literally both my wife and I, because she's also a CPA, both of us, we are reading the tax law inside and out every single day. It's over 1,000 pages, the new tax law. We read it multiple times, and now we've got regulations, and they're hundreds and hundreds of pages. So it's really is your tax advisor focused on the future, or are they historians focused on the past? You really want an advisor who's always focused on your future and not telling you what you can and can't do, but how you can do what you want to do.
Mm-hmm. I love that. Okay. That's some great advice as well. So, okay. Well, then I think we pretty much have covered a lot of different things. And so, you know, Tom, it was a great pleasure to have you on. It was, you know, I learned a lot of things, and hopefully my audience was able to pick up some things as well. Is there anything else that maybe we didn't discuss that we kind of left out, or anything that you can think of?
No, you know what? I would encourage you. We did a second edition of Tax Free Wealth, which is my best-selling book. Mm-hmm. And in that book, if you buy the book, there's a free ebook that is the top 10 ways to benefit from the Trump tax bill. So we did a second edition because we had to change so much in the new book that, you know, that's all, you know, that's always going to be my response is first go read Tax Free Wealth. And if you haven't read it in a couple of years, I would suggest picking up the second edition and reading it again to see what's changed.
Yeah, no, I was gonna say that's a must-read book for anybody out there. Anybody out there that, if you want to build wealth, I mean, you have to read, you know, this book. You know, it's a must-read along with, you know, the motivational ones. You know, Think and Grow Rich. I mean, you name it. This is up there with those. So, read that book. It's on Amazon. I mean, where else can you get that book? Maybe on your website.
You can get it Amazon, get it Barnes and Noble. I mean,
okay.
It's in most bookstores. So
Gotcha. Okay. Well, Tom, where can Commit to Wealth Nation go to contact you and find out more about you and your company and your services?
Pretty easy. Just go to wealthability.com. Wealthability.com.
And check out his podcast as well. So that's the Wealthability Show with Tom Wheelwright. So make sure you check it out. It's awesome. So, right. Well, once again, Tom, I appreciate your time, and you know, have a great rest of your day.
Thanks very much.
You too.